Lorraine, let's get into energy. You're recommending going long energy, especially in upstream and services. Can you tell us why?
Well, we have generally a fairly positive view over the midterm for energy. Yes, there is going to be excess supply still in the near term that will probably keep a lid on how far prices can move ahead. But we're still seeing equilibrium level probably for crude oil at around $70 to $75 per barrel range over the next few months. And in essence, you've got a decent demand pickup with the global economic recovery. So we're liking stocks like CNOOC, for example, where the management is obviously has been very strong and very transparent. We're also favor the oil field services operators because their earnings have not really fallen this year, and we're expecting things to be relatively stable for the following year as well.
Lorraine, let's dig into CNOOC. You just mentioned it there. It's China's National Offshore Oil Corp, the country's third biggest oil explorer. BNP Paribas raised its rating to buy last week, and Morgan Stanley back in July raised its rating to overweight. So clearly strong signals for investors to buy this stock. What's your take?
Yeah, I agree. I mean, it's probably our preferred energy pick at this point in time as well. Valuations are not demanding, for the sector as a whole, as well as for CNOOC. It's a very easy to follow, transparent company, which is something that we like going ahead as well. And it's got its CAPEX plans in place. ROE is expected to improve. This year will be obviously a dip in earnings because of the fall in oil prices, but we do expect a much stronger second half over the first half.
And you recommended using utilities as a hedge. I'd like to ask you about that and get into Datong Power. Shares of that company up 26% year to date. It's China's largest power producer by market value, trading at 74 times earnings here in Hong Kong. Curious what you make of this stock, why you like it.
Well, the power sector has really lagged in performance. I mean, across the board in Asia Pacific, it's probably been the worst performing sector. China-wise as well, similarly, underperformance. We do expect some of the favor to come back into the China power sector because of the turnaround in profits. They had a very bad year last year. A lot of companies made losses, and hence that's why you see a 74 times earnings for Datong. But this year will be a different story. We're seeing PEs back down to more reasonable levels of around 15 times or so. And with benign costs, coal prices are still relatively much lower and still quite stable. We're expecting margin expansion for the companies this year.
Let's get on to some of your other picks now. We want to fit in as much as we can for our viewers, and we'll zero in on Singapore's Capital Mall Trust. It's Singapore's biggest property trust, and the company said in July it's going to pay investors about 16% more in dividends for the second quarter. Is this one of the reasons you like Capital Mall?
Yeah, it's got to be the main reason. I mean, if you're talking about a stock to sort of offset the volatility, I think this is one that we like. And we also see that it'll benefit from an improvement in the Singapore economy, plus the opening of the IRs at the end, or integrated resorts at the beginning of next year. That's probably going to drive activity overall into the property sector. Obviously, the real estate developers will benefit from that. But CMT we see as being a better value right now.
Shares seem to be lagging the market there. We see them down right now about 0.6%. As we look at year-to-date performance, they're up 11%, although the Straits Times Index up about 45%. What's your take on the stock performance here and the outlook going forward?
Well, it is lagged because it seemed to be defensive. It's into shopping malls, and that's discretionary spending has been negatively affected by the downturn, and then by swine flu. That's a concern. But it's got good assets. It's got as I mentioned, the dividends will continue to be paid. The yields are decent. We're expecting activity on the shopping front to have bottomed out. It has the potential to benefit from future acquisitions. Its parent does have a pipeline of assets that it could put into Capital Mall Trust in the future, and it's gone through its rights issue, so it is very comfortable on a balance sheet wise as well.
Lorraine, just about 20 seconds. Taiwan Semiconductor, in just a few words, tell me why you like this stock.
It's lagged recently. The technology sector has done very well. Recent earnings for 2Q were better than expected for the most part, and the guidance was actually quite positive. So with the global economic recovery, I think the chip sector has to do well.
Lorraine, we've got to leave it there. Lorraine Tan from Standard & Poor's in Singapore, thanks so much for joining us.